Hey everyone, hope you're doing super well. We have a good video coming up for you today about really some of the things that traders don't talk about too much. You cannot hear this on YouTube much. There's very few advice on these kinds of things, and I thought it'd be good to cover it. So I picked up some good interviews from all traders we've interviewed on the podcast and put them into this video. You get to hear some of the secrets of long-term success in trading, how to manage finances, risk, and building wealth over the long term, as well as what it takes to manage drawdowns, and some of these unsexy parts of trading, which is what you got to be aware of for long-term success in the market. I'm sure you'll get plenty of value out of this. Make sure you comment below with your favorite advice from these traders, and we'll dive right into it.
Yeah, I prefer on like higher time frames. So I don't want to spend too long at my charts at all. I've learned that consistent results are consistent trading, and I don't want to be consistently at my charts all day, every day. So I tend to pick systems that will take me 10, 15 minutes every day just to check through. So in order to do that, I use the daily time frame for a lot of my trading. And then I have a small portfolio that I use intraday time frames, like 4 hour to the hourly sometimes. But there's only 8 pairs in that portfolio. So it's manageable, and I only do it for like a few hours, a couple of hours each day. But the majority of my trading, so my swing trading or my daily time frame trading, I've got like 28 pairs that I monitor on a daily basis, but it only takes me like 15 minutes because it's basically just a checklist. So I kind of see my life like Tetris, where I want to do less and have more time and more space freedom, right? Just like yourself. And if I can make money doing something, the first thing I ask is, how can I do it less, and how can I do it like be more flexible and more mobile? So that lends itself to suit my lifestyle a lot better of where I'm at in life now. So yeah, much higher time frame, not as active, but still make as much money because of the portfolio size and the amount of strategies that I trade across that portfolio. So in my intraday trading system, I trade something called a smooth ratio money management system, where it's a fixed position size and I have a maximum risk limit, and only when I go into a winning streak I can increase that position size after a period of winning streak. And if I have a losing streak and it goes below a certain threshold, I have to decrease that position size, and that is a fixed position size, and that's on 8 pairs. In my swing trading, my daily time frame stuff, where I trade all the pairs, I have a fixed percentage position, so it's a fixed risk amount. So 1%, it's actually just under 1% per trade, and then I have correlation risk that goes into that as well to make sure that I can't take, not be overexposed in certain conditions and situations. We touched on one about time for money. I think that's a big one. Second one is, what I find that the biggest struggle is when you're learning to trade, you spend a lot of time in the markets, right? Because you're not only learning the concepts and the theory, you're also learning the technical side, and you're learning the practical side, and you're learning your way around charts, and you're learning different things, and then you're learning strategies off by heart, and then you're drawing strategies on, and you're testing stuff, and all of your time is spent consumed with this trading world, right? And then when you get to a certain point, you've developed a system, it's got a profit, it's got an edge, you've got a profitable projected system because you've tested it all. If you do X, Y, and Z, you'll get X, Y, and Z result, or you should do. And then the next day, you go, right, now I'm ready to open an account and start trading. And one day goes by and you don't get a setup. 2 days go by and you don't get a setup. And then 3 days go by, you get one setup. And all of a sudden, your time has gone from every minute in the charts to not very much time. And that starts to make people think, what am I doing wrong? Why aren't I getting any trades? If they just look back at all of their test results, they would actually see, oh yeah, it's kind of 3 a week or 1 a week on average. But it's the time that you've put into all of that compared to the time you're in it now is the struggle. It's like, I should be doing more. And that is a really dangerous place to be if you haven't got a support network, because no one's watching you. You're on your own. No one else really cares. And you're just going to start placing trades that you shouldn't be in. And I think loneliness is the struggle. I think it's just like feeling like you should be doing more is a mindset that you need to work on, because as a trader, patience pays the bills. Like, patience is what's going to pay you, not just getting in for the sake of it to say you're in a trade. That's why I think a lot of those prop firms are flawed, because, you know, you're teaching traders, you're incentivizing traders to make a certain amount of money in a certain amount of time, where no professional trader in their right mind could tell you that they're going to make a certain amount of money in a certain amount of time. I don't know when I'm going to make money. Yeah, I just know that I will probably make money over the next 12 months. I can't tell you when. I can't tell you that I'm going to make money this week or next month or even in the next couple of months. I don't know. I think it's just about having systems in place, like journaling and reviewing not only your technical performance, but your emotional performance as well, and just staying in check. So making sure that, one, you're not taking excessive loss in your trades. 2, you're trading exactly to the plan. So 3, you're taking trades that you should be in, and you're not missing any, because under trading is a thing as well, right? Also, make sure that you're not in trades that you shouldn't be in. And then also make sure that you're managing your trades correctly. And if you're just journaling that on a daily basis, so you take the trade and then you do a checklist. It's like, did I take excessive loss? No. Was I supposed to be in this trade? Yes. Did I miss any trades that I should have been in? No. Did I manage the trade correctly? Yes. Right? And then if the answer to any of them is the other way, you want to take note of how much you won or lost as a result of that error. And your goal should be to make that 0 all the time. You know, you should always try to not gain anything or not lose anything by error. You just want to make money by trading it flawlessly. And if you've got a system in place where you can check that on a daily basis, you're very unlikely to struggle in drawdowns, because you can compare it, right? You compare it to last year. You compare it to the last 10 years, 5 years, 3 years. You compare it to your test results. You compare it to your own analysis of your performance. It's like, right, was I emotional that day? Did I trade as I should have? Did I start early? Did I start late? All these things, if you keep on top of that, if you go into a drawdown and the answer's like, oh yeah, I shouldn't have been in this trade, well then that gives you peace of mind, because you know, oh, I'm in this drawdown because it's my fault. You know, I shouldn't have done that. Or if you're in a drawdown and you've done everything that you should have done, then that gives you peace of mind that, well, this is expected. You know, this is an expected drawdown. Have I exceeded my maximum historical drawdown? No? Okay, well, let's just keep going, because I know every loser is one close to the winner. And if you do find yourself in a position where you have exceeded like your maximum historical loss and you are trading it flawlessly and you're not making any mistakes, then it's time to just stop and go, I need to review this system. I need to review this strategy and make sure that it's still, you know, there's not something wrong with it, or it's not changed or lost its edge or deteriorated or something like that. Don't track it. So where do you start to, like, every system is going to deteriorate at some point. The edge is going to change. It's your job to stay on top of that and optimize it and make sure that it's continuously profitable. If I just opened a shop that sold milkshakes and I said, oh, well, everyone buys milkshakes, and it went really well, and then I just walk away and go, oh, that'll sell milkshakes forever. And then some other shop opens up next door with like these amazing ice creams and milkshakes, and I just neglect it, of course I'm going to go out of business, right? So it requires me to be in that business to say, well, what are they, how is this affecting us? What's the change in trend here? Who's going next door, and why are they going there? And I need to make this or change this, or you have to do that in trading as well. If you don't do that, you're going to at a point that it will come a time where you're no longer profitable or you're struggling to make profit and you don't have an idea why. And it's back to the drawing board. It's back to square one. You have to start again. You have to develop a new system or do another strategy or whatever. Whereas if you just keep on top of it, it grows with you. It becomes more profitable because you know it even better. You don't struggle with that. So, yeah, I don't know why people don't journal their trades, because that is literally your next set of backtesting to keep you sane. If you go, do you know what? I'm having a bad summer this year. Let me look at last year's results and the year before that. Oh, I don't have any. Whereas if you said, I'm having a bad summer, let me look at last year. Oh, actually, last summer was exactly the same, or the average of the last 3 summers was the same, then, oh, okay, that makes sense. I'll just write it out. It gives you such more mental clarity and psychological strength if you've got that journal data, right? Otherwise, how do you get better? What gets measured gets mastered. I just think that you have to have stable mindset, right? And you are not going to have a stable mindset if you take everything that's in your bank that you need to pay your bills and put it into a trading account and start volatile trading, right? That is not going to end well for you. So our mind, the best way to describe this is the comfort in our mind is based on how long we can survive for, how safe we are, right? Now, love it or hate it, money is directly linked to our survival because we need money to pay for living. That's it. So the more money you've got, safe and secure, is going to activate a new level of your mind, a new level of creativity. If you haven't looked up Maslow's hierarchy of needs, go and look that up, right? It's basically how our human psychology, how we are as humans. And the best way, the easiest way to look at that is if I've got 3 months, 6 months living costs in the bank, it doesn't have to be investing in the market. It could just be in your bank. Then anything on top of that you put into trading, you're going to manage more wisely because you're not desperately trying to make a load of money and you're not scared of losing it, right? Because you've got this cushion. So take it or leave it. The best way to learn to trade and to go all in on trading is to at least have some security first. And that, I think, is the biggest missing piece. Most people that I see trying to get into trading, of course, there's people who have earned a lot of money in their life and they want to manage it better and they want to learn to trade. Great, that's perfect. But there's a lot of people who don't have any money and they want to learn to trade to make a lot of money, but it's flawed because they can't learn because of the way that their mindset's wired at the moment. And if they take everything they've got and try and learn to trade, they're gonna lose it all because they just won't have they won't be calm enough and poised enough to not only have logical decision-making processes that you need that demanded of you as a trader, but they won't be able to trade the markets. They just won't be able to. They haven't earned that level of risk. Like they haven't earned their right to risk. So, yeah, so it's a tough one. Unfortunately, most people who are broke want to learn to trade quick. The beauty of trading is like one of the only money-making businesses that you can create and get to a point where you know you're going to be profitable without even spending any dollars, right? So you can go and learn all of the charting. You can learn all of the fundamentals, all of the technicals. You can go and open up a demo account. You can go and test a strategy and trade a strategy and build a strategy. You can go and test it, see if it's profitable. And then the day will come where you know that there is a high probability of if you do this, you will have this profit and you haven't spent any money. And then you put your money into the account and you go, right, let's trade it flawlessly and you start bringing in money. I don't know any other business like that where you can pretty much, write a business plan that is going to be profitable before you've invested any money. Trading is phenomenal like that, but people seem to want to put money at risk to feel like, and I know why it is, it's for many reasons, but it's like, what if I trade and it wins? Which is the completely wrong way to go about trading anyway. You want to be thinking a little bit longer term, build the skill, Prove to yourself that you can be profitable. Focus on percentage, not money. Do it for 6 months. Do it for a year. Focus in just percentage, not money. And then prove to yourself that you can be profitable, because no one else cares. And then when you can prove to yourself that you're profitable, 6 months, 12 months, money is easy to find after that point. If you can prove that you can generate 10, 20, 30%, whatever, 40% return, whatever it might be, there will be people willing to give you money to trade. Do you know, when there's a story, when I was learning to ride a motorbike, I learned quite late on. It was like, I don't know, 5-6 years ago. And the instructor said that a lot of the kids, they don't pay for their test and the insurance because they would rather spend the money on the gear and the helmet and the bike, right? And you think, well, that's flawed. Like, they're driving illegally and that's not going to last very long, right? But they'd rather have that because that's the result. That's the result. They're riding around on the bike. And most kids lose their license forever here because they don't ever take their test or get insurance because it's money that they want to spend on the bike. In trading, I see people say, oh, I don't really want to learn. I don't want to pay to learn because I want to put that money in my trading account. And it's like, what? What are you, like, what planet are you living on? Like, you're going to lose that money and then never have that money again. Whereas if you spend it on your education, learn the right way, then you'll make loads more. But it's crazy, man. Humans are so crazy.
I kind of fumbled around for my first couple of years. I was negative, but not much because I was really risk averse. So I wasn't willing to put on big amount of money. And it goes back to all that psychological stuff from growing up really financially constrained. So like the money that I had, I was like holding on to. I was too scared to risk it and give it up, that was a big thing to eventually overcome. But those first 2 years of trading were actually my only negative years. So from essentially those periods forward, and the worst drawdown was less than 5%, or the worst loss on the year. I've had bigger portfolio drawdowns than that. But the first 2 years were slightly negative. The next few years after that, there were nothing impressive. But I started at least getting my feet under me enough. But it was really difficult for me to put money to use, which in the beginning was kind of beneficial to me because I would have lost way more. Like if I had a slightly different relationship with money, I probably would have put on trades way too big and lost a bunch, my guess is. If you want to talk about like because I still consider myself to this day too risk averse, and I'm 33, and I've done fortunately very well trading. I'm very thankful for that. I've started spreading into other asset classes like commercial real estate, angel investing. I started spreading as I started developing like a base level of wealth that I was comfortable with. And there's two things that I think about. The first thing is something you've all heard before, but the money that I put into a trading account, I think there has to be a psychological detachment from that money. So I literally started putting myself through different exercises where I would open up my platform and then I would pretend to see another number. I would like literally visualize seeing red, even if there was or wasn't red in terms of, the account P&L for the day. And I would kind of like put myself through the visualization process of like actually thinking about the account being a different number than whatever it was. So like, let's say it was red $1,000 on the day or something super small. Well, I would add a 0 to that mentally. And I would just start to try to like desensitize myself massively so that I can try and get used to seeing that kind of exposure. And the only way I was able to get there was the money that was going into the account. I genuinely would view it as money that I was not getting back. And that was really difficult to do in the beginning because I put all of my savings into it. So that didn't work well with one another. And it leads to the second thing that I did, which was as I looked at the capital, I made sure that I had enough in savings that I was comfortable, that if the account were to draw down massively, that my livelihood isn't challenged at that point. The ability to feed myself and stuff like that is not challenged. And I can like truly focus on the skill set with the trading capital. And I would say the third thing to tack on a bonus one is I started doing a lot of paper trading. And by doing a lot of paper trading in the beginning, I logged a ton of it in Excel so that I could actually see the skill set. And I can I was able to really amplify the number of trades I could put on, right? Because my account would run out of money way before I was at the end of, what I could put on. And the process of paper trading is really sneaky in that sense, because if you treat it with respect, it can teach you a lot about a prospective system that you're trying to run. And long story short there, confidence to me comes from a demonstrable skill set. The ability, it's not from like just hyping yourself up and thinking like, oh, I'm the best. Because if you don't actually think that, because you don't actually have any sort of track record to back it up, you don't actually believe it yourself. You're just saying shit. So when I look at the ability to start scaling up capital a little bit, the biggest thing was really starting to look at the skill set and say like, okay, there's losing trades. I'm okay with losing trades, but I can see in the aggregate, this is working well. This is worth putting my money into. So those are really the three things: psychological detachment, making sure that you have enough saved so that you're not eating into essentially what maintains your livelihood, and then the skill set validation. Well, there's definitely a bunch of different things that I ran through, but the biggest one, bar none, was getting organized. Because especially with options trading, there's a lot of different structures that we would call them, right? You can buy or sell to open trades just like you can with stock, but then there's all these different kind of legs you can build to make these really complex structures. And in the beginning, a lot of us in options trading think that there's edge in options themselves, and there's not. Like, options are just a product. It's just something to trade. It has slightly different behaviors, pros and cons, of course, but there's nothing that if I trade an option, I'm inherently going to make money, right? There's no baked in edge. So the first couple of years of trading, it was just pure randomness. I would have a really haphazard approach where I would come across vertical spreads and I was like, oh, wow, these look really great. They're defined risk, defined profit, higher probability trades. This looks great. And then I would trade them for, a couple weeks. And then I would have like 4 losing trades. And then I would start tinkering with what I'm doing. And then it would work again. And then I would have losing trades again. And then I would tinker with it again. And by the end of that, you look at the what you've done with this system, and you have this thing that never had a chance to even show you its actual returns because you're not giving it any time. And I'm not confident in it because I didn't back test any of it. I was just kind of, figuring it out on the fly. So the biggest thing that I did to pivot all of that was starting to get supremely organized. I developed a written trading plan. I developed a trading log to actually document the different changes that I was doing. So then if I'm selling a 30 delta, short call and buying a $1 wide wing, maybe in paper trading at the same time, I would test doing a $2 wide, $3 wide, $4 wide. I would test different short deltas so that I could actually see how these things worked before I would make a random change because of bad path of returns and then really have nothing to show for it. It was just complete randomness. So getting organized, hands down, pivotal. In the beginning, it started with Excel. And then as I came across different people in college, I actually have a buddy that I played rugby with that he's into like computer programming and stuff like that. So he helped me understand some basic coding through Python and things like that. So I would automate pieces of it. I actually had most of it automated for a while from a logging perspective. But then I actually realized that I was getting, I was like losing sensitivity to like what I was doing on a daily basis. And like the actual manual entry process for me is like really important. It keeps me so close to each metric that I'm looking at versus just getting a readout. So I've actually regressed back from having everything automated to now going back to Excel and Google Sheets. It keeps you super close to it. So it's not like just getting a readout of, this trade was a losing trade and it's just a number, right, that you're looking at. You can actually, like, as you're inputting that losing trade, it's a different experience than just seeing it spit out to you. So yeah, I found it really, really useful. I do automate elements of my trade log and stuff like that for efficiency. Like I don't want to sit there and have to manually input stock price, right, when I'm comparing entry versus exit. So I can pull that kind of stuff in. But yeah, like most of the actual components that are relative to the trade and the strategy, those will be manually input for me. the benefits that we have in different ways to play the game to outperform the market really changes the dynamic of like what we're trying to achieve, I think at least. There's a few different ways that you can do it. For me, the largest portfolio drawdown that I had was just over 30%, and it was on a single trade. And that was a few years into trading, like 4 or 5, I want to say. And that was a massive wake-up call, because at that point I was trading short premium strategies, really high probability of winning all the time. And then I started focusing a little too much on how much I wanted to make in this really wide iron condor in the rut. And it ended up temporarily moving against me. Long story short, led to literally over a 30% drawdown on the account on one single trade. So that forced me to kind of like reconsider everything. So for me, what I do now is I institute kind of 3 broad protocols. The first one is I trade a mix of assets and strategies. So I create a little bit of diversity in the portfolio. So like even right now, we're at all-time highs in the market, but I still have trades on that are short deltas, meaning benefiting to the downside. I look for weakness so that I can trade things to the downside, because what I do know is that if the market starts to roll over, the things that are going down today are way more likely to accelerate to the downside. So I keep a mix in the portfolio that way. Then I set very, very specific per trade risk control metrics to limit max total loss in individual trades. Then the third thing is I deploy portfolio level circuit breakers. So let's say I'm trading a broader book at the time, and let's say that I have 150 trades on, something like that. Well, if each one of those is sized well based on a percentage of the portfolio, if all of them draw down at the same time, it can still lead to excessive loss. So what I do is I have specific thresholds for the portfolio that if the overall portfolio value drops more than 10%, I'm going to start cutting trades. I'm just going to start cutting trades. Even if they look good, they don't look good, I'm taking risk off the table. So it's a way for me to manage risk in kind of multiple levels. That's the best possible way I've found so far, because allocation, how much money I'm using at a point in time, is massively important, because you can only lose what you're risking. But I don't just trade options, I also trade futures. And if you have a short call, or if you're selling a future, in those contexts, you can lose its undefined loss potential, technically speaking. So you can't count on, some sort of max loss being the investment you put into it. You have to be the max loss. So I use 2 different kinds of stops. I have a soft stop or a mental stop typically, and then I'll have a hard stop. The hard stop isn't always resting, but the hard stop is a non-negotiable exit that's determined before entering every single trade. So every single trade, I will define the exact spot that I'm going to get out. A lot of times, if it's a futures contract, I'll rest the order and I'll just have it live there, leave it good till canceled so that it can fill in the middle of the night if I want, something like that. And then the soft stop is kind of like it's a heads up that this thing's starting to move the wrong way, meaningful enough that it looks like it's not working. The vast majority of instances, I exit on the soft stop, but I give myself the choice in case it does look like something might turn around a little bit, something like that. And what I found in the beginning, I used to always violate the soft stop. It essentially just shouldn't have been there. And that's because of the disposition effect. But once I understood that's what I was doing, I really pulled that back pretty massively. So that's really the 3 main things that I do to limit portfolio drawdown. I use non-correlated securities that I'm trading and strategies. I use a mix. I deploy individual trade level risk management protocols. And then I also deploy portfolio level circuit breakers so that even if all the trades start going wrong at the same time, I'm going to start pulling risk down. That would be the third thing I would offer. So yeah, I think those are kind of like 3 of the big mistakes I see. It's learn to love it. In the Marine Corps, we call it embrace the suck. Do it like you love it. And I adopt that mindset straight from the jump. So sitting down and like logging your trades, it's monotonous, it's kind of boring, but I don't allow those thoughts. Like when it comes time to log the trades, I don't sit there and think to myself like, oh crap, I don't want to do this. I don't allow those thoughts. And the way that I encourage myself to like really focus on it is, again, going back to that compound growth calculator, because seeing the ability to become a millionaire before you're 30 and to see what you can do with that money then from there is very incentivizing. If you can embrace an element of delayed gratification, meaning sacrificing up front. The sneaky part about delayed gratification is the more you delay gratification up front, the sooner you get to it. Kind of a cool function. So that is what I continue to look at when I didn't want to do something, when it didn't feel like I wasn't in the right mindset after rugby practice or something to like sit down and start reading again. And I literally would think about that. I would think about like, if you build this skill set now, in the not so distant future, you're going to live a lifestyle that you will really enjoy. It's the kind of lifestyle that most people tend to aspire to. But again, going back to that previous thing, they like the idea of it, but they don't like the work that it takes to get there.
Drawdown is part of it, right? And again, I'm a high performance tennis coach, as we may have talked about before. I still love coaching, and it's still very much a passion of mine, and dealing with all of that, right? I've studied the ability to lose and how to lose, all that. I get it. And trading systems, they all lose. But I started thinking about, if you're going to retire, or if you're going to build an addition in our basement, let's say, or let's do some architect. If we're going to do something for real in our lives, how do we start that in a drawdown, right? Or, we just bought a new house, right? We never really had a big house. We wanted a big house. So we bought a nice house, and it's like, that comes with a big mortgage payment. Well, what do we do about a mortgage payment if you're in a drawdown? And we're not. We both have incomes, and so we weren't relying on trading per se. But what if we wanted to? Okay, well, our future system, the portfolio went into a drawdown July, into about a 3-month drawdown. It just wasn't making new equity highs, and it was gradually grinding downward. And it's just hitting me. It's hitting me. It's like, this is part of the game. However, I don't want this game. I want money. I want money coming in all the time. Like, how can she retire? How can I retire? I mean, I love what I do. I don't really need to retire, but I want her to retire. How do we do that in a 3-month drawdown? And it's no different than the sequencing risk that people who retire and do the 4% rule, which is kind of ridiculous. But it just occurred to me that I can't really live my life and make plans if you're going to go into drawdowns, and trading loses, period. So that's why I thought, have I been thinking about this all wrong? Like, have I just been chasing the wrong thing since 2004 when I started to fall in love with trading? So that's when I made it. That sort of mindset is what made the big transition into where we're putting a lot of our money right now. It was the drawdown, yes. Well, what I'm wondering is, like I said, am I playing the wrong game? Is trading the wrong game? And things started echoing in my mind, like, for example, Warren Buffett's famous quote. And he says, if you can't learn to make money when you sleep, you'll work forever. You work till you die. And it's like, okay, Warren, Warren says stuff, and I love Warren Buffett, but, he's got hundreds of billions of dollars or whatever, so he's not really relatable. So I've kind of blown that off. But I got to the point I don't want to blow that off anymore. Like, I want money coming in when I sleep. I want money coming in all the time. I don't want to worry about these drawdowns, or worry about, I woke up today, I didn't make money when I slept, so how am I going to make money? So the answer, of course, has been around right in front of everyone's eyes, and that's dividends. Buy dividend stocks, buy the dividend aristocrats, buy the dividend kings, because here you go. You buy a stock and you hold it. You buy Johnson & Johnson and you hold it, and it pays a dividend. And if the good ones pay you more money, and that money's coming in every quarter, and it keeps getting bigger, and as soon as it gets big enough, it's always coming in, and you're set for life. That seemed like aha, that is exactly what I was looking for, except for the fact that dividend stocks are terrible, right? Because no one can do anything with Johnson & Johnson. Like you and I can't do anything with Johnson & Johnson. If you bought, or the SPY, right? The SPY, if you bought and held it, would pay you like $100 a year, on a reasonable amount, like 10,000 or 12,000, $20,000. So dividends got the right idea for sure. It's just, it's just not enough money. So that's why we turned to trading, right? I mean, I knew about dividends a long time ago. I loved dividends a long time ago. I've read every good book out there about dividend investors, and I've spent hours studying dividends, and it's not enough. It's nothing that we can do today. So, not to belabor the suspense, but in the last year, it's become really popular, and it's these high yield dividend stocks, right? Which are not even stocks, they're ETFs. But high yield came on the scene. Really, the first was TSLY, Tesla, based on Tesla. And that was late 2023. That was really the first big name. And it's revolutionary because it was paying 50, 60, 70, 80% yield. And it's and just everyone just, looked down their nose at it like, this is absolutely ridiculous. It's another Wall Street trick. It's garbage. It's trash. And it just kind of did its own thing for a while. But all of a sudden, high yield has become everywhere. And more single stocks got offered. And now index yields, high income ETFs and high yields have come. And now they're everywhere. And I studied it and I watched it and I watched it and I watched it. And I'm like, isn't this the answer? I mean, at least for what I'm looking for. If something's paying a 50% yield, I can work with that, right? You put $100,000 in, you're going to get paid $50,000 in a year, right? That's pretty good. Why doesn't everybody do this? And there are a lot of reasons why everybody doesn't do it. They're not very good reasons, but I just started getting more and more attracted. Like, well, let's see if it's a 50% yield, again, just hypothetical, even though that's what these yields are. Well, the more shares I buy, the more money I make, period. There was a story I read in a YouTube video about a guy, he built himself up from scratch trading the SPY, the SPY. And he just treated it like an ATM. And he just, every time it went down, he threw money at it. And he just, money all the time. And it's great. His account grew, but he's not making income, right? And I thought, well, what if you did that exact same thing and it actually mattered, right? Every dollar you put in actually pays you back every single time. Differing amounts and all that. But, it just kind of blew my mind. This is what I want for my money. There are no 3-month drawdowns, right? It's paying you money. And you can do it monthly, and now it's weekly. And, the entire mindset change of you wake up and you go to your computer and money's coming in regardless. It's just blown me away. And that's the thing too, right? Because it's an obvious question. You look at Tesla's chart. You look at one of my favorites, CONY, which is Coinbase, which is super volatile, right? Look at the chart, and people are like, who might be raise an eyebrow, thinking you see that much yield. They think, oh, well, look at the chart. Look at the chart. But looking at the chart is all wrong. That's the whole problem, and that is a great example, and it's not mine. But you think of Ford or Tesla or any car company, they buy a factory. Okay. What's the point of that factory? To make cars. And why do they make cars? To make money. So when they're going to go build a factory, do they look at what's the cost of the building? They do, but do they look at, is the building going up or down in price? How much is this factory? What's this factory worth next month? Oh, the land values have gone down. We better sell this factory, even though it's only been operational for 30 days, right? It's ludicrous, right? You don't do that, right? If something is producing money, that's its only job. That's all it's got to do. So to answer your question directly, I don't care. I don't care what Coney does. I don't care what Tesla does. Because why should I care if I'm going to sell? Because we've all been trained, me included, When you look at the stock chart and it must go up. Your portfolio or your automated strategies, it must go up. If it doesn't go up, you lose. We're all trained for this, me included. But what if it didn't matter? What if the only thing I cared about is if it paid? Then I don't care what Coney does, and I don't care what Tesla does, and I don't care if it goes down, because if it goes down, I can buy more shares at a smaller price, at a cheaper price, and all of a sudden now I have more shares, which means more income. It's not for anyone who cares about a stock chart. It's not for anyone really that has a mindset of, well, I'm going to make this trade and I need it to go up. It's about people who say, I want $100 a month, then I want $500 a month, then I want $1,000 a month, then I want 5,000, then I want 10,000, then I want 50,000. Like that's what I care about. I don't really look at charts anymore. All I'm looking at is how much is my income gone up. I mean, my income's gone up like, I don't know, 7 or 8 straight months. Like I make more this month than I did last month, and next month I'll make more than I did last month. And that's all I look at. But again, totally different, and I get it. And what's fascinating is you get into this world of, the big money coming in, and there are so many different ways to do it, which is crazy. You don't have to go for the crazy ones like Coney or Tesla or NVDY or any of these. You don't have to do any of it because there's more of these products coming out. You can trade an index, and that stock chart might actually go up over time, right? So if you need the stock chart to go up, and you'll take a much smaller yield, so you're getting much less payments. However, your stock chart's going up, which means I mean it's comforting because you could sell it and not have a loss. I get that. But something like that, where we're talking about 20-25% yield, and the stock chart actually might go sideways or up, you could theoretically do it all. Like, okay, I've talked to gradually people are asking me what I'm doing, in my real life, not just on interviews, and I tell them. And they're like, immediately tell me more, right? Because everyone's interested in income. And their idea is, well, I'm going to put several thousands or tens of thousands of dollars in a simple one that trades an index, because it's not going to go to zero, and it's not going to go defunct. It's not going to be volatile, and it's going to pay me not 2.1% like Johnson & Johnson. It's going to pay me 20, 30, 35%. So in that case, you could just put it all in it. As far as if you wanted more and you want to build your income, you want to say 2 years from now, I want to be making $15,000 a month from my investments. Then you're going to have to, I would say, divide it up. And so if you had $10,000, maybe pick 4, right? So you can get paid every week. So you choose one that pays on the first week of the month. You choose the next one that pays on the second week, third week. So every Friday you're getting paid, which is nice if you want to budget and pay bills. And then you'd put like 1 quarter in each. And then what do you do? Well, you could start with any amount of money, but then what do? You say, okay, well, money's coming in. I don't need it right now, so it's going immediately back in. I'm immediately reinvesting. If you do that, then guess what? You're guaranteed to make more money, almost certainly guaranteed to make money next month. So you could do it that way too. Some people say, every down day, I'm going to buy some more. You don't really need to. You're not buying it for the stock chart, but every down day, so they just go in and boop, 10 more shares. Boom, 10 more shares. You can do it that way. With Robinhood, which I thought Robinhood was just silly. I mean, it was for, gambling addicted, people back in the pandemic. Robinhood is the kiddie land. Robinhood is great. I have Schwab, but Robinhood is great. And you know what Robinhood has? You can buy every day. So you can set it up. I want to buy something like Coney. Buy me $10 every day. And just do it that way. And lo and behold, you wake up in several months and you're going to end up with more money than you had before. Lots more money, right? Again, will the stock chart go down? It might. Will your total return go down? No. But I mean, again, you gotta have a mindset and know what you're getting into, and you have to totally understand it. There you go. And there you go. And I think I've heard all the arguments against it, and I think that's the best one. Listen, for whatever reason, I got to sell this thing. I have to close my account. I'm moving overseas. Oh, well, I've been getting all the income from this, and now the stock chart has gone down. Your total return could be even or even positive. But look, I bought it at 100 or I bought it at 50 and now it's at 20, right? That's a real problem. The counter argument, though, to that is, how much have you been paid? It's like, is your home paid off? So, for example, you buy something with 100% yield, which Coney many months has 100% yield. Okay. Stock chart goes down, so you may have to sell it, but can you hold that for a year? Because guess what? In a year, you got all your money back. Okay. So you're selling it. Maybe the stock chart did drop and you are selling at a loss, but it's already paid off, right? If you sell a house later that it's already been paid off, did we lose money? So yes, if you buy it and it goes down in 6 months and it hasn't paid itself off, yeah, that's a loss and that's a problem. But everything I've bought since day one, I'm never selling. I'm telling it to you and to your big audience or whatever. So I'm never selling, It's a stupid rhyme, but if it pays, it stays. I don't know who said that. I think I made it up, but I don't know. But if it pays me, it stays. So the answer to you, I'm never selling. So I don't care what the stock chart is. But yes, that's a very good example. It does feel that way. I'm not afraid of it, and definitely don't do it. And no one has to do it. But if you get a margin call, you just have to wait for the next dividend payment. I mean, it's literally it. And the worst case scenario is if you're on margin and you need to sell, you get a margin call and you're like, they said, the dividends aren't in yet, pay us now. You're selling a stock, a few shares of a stock. Again, it's tiny. It's going to be a tiny amount. A few shares of stocks that you didn't own anyway. So why, it's not going to cascade. A margin call with regular stocks can cascade because stock goes down, you sell, it goes down, you sell more, and it's a reverse snowball. But you're always getting paid. So the margin call goes away. It'll eventually just go away. Again, nobody has to do it. But I love it. It's wonderful. You get more bang for your buck and money's always coming in. But again, if you're a buyer and a seller, yeah, I wouldn't do it. Yeah, you got to be a holder with this type of thing. Again, this couldn't be more alien to all the things that I've thought and talked about over the past several years, but just obsessed with it. Start with $50 or whatever. I mean, all of these are under $50. Buy one share and just watch it. When people ask me, that's exactly what I say. I say, I'm going to be 6 figures and beyond in it probably. I'm escalating, 10,000 this month and 10,000 last month. And, I keep putting more and more in. Start with $50. Just watch it. Start with $75 and buy a couple and just watch it and see what you think. It is liberating to know that money's always coming in. I mean, it's changed my life without a doubt. And I love trading since day one, since second one, but nothing has been as euphoric as this. To know that I'm moving forward with my life and my assets are always paying me. A wise billionaire once said, never buy anything that doesn't always pay you back. And I never got it, but I get it. I get why they say that. But you buy apartment buildings, you buy precious art, or you buy dividend stocks, or you buy high yield dividend stocks, and that stuff pays you back. Absolutely, I would go to the big names, which are the big four in this world are TSLY. That's Tesla. I don't love Tesla myself, but it's the original and it's been around forever, and that's the most data, right? I've always been a data guy, right? I have to have 20 years of data before I test or trade a trading strategy. Tesla is the long, and again, none of this has been out very long either, which is a really great reason to be scared. I get it. But TSLY is one. The second pillar is NVDY, NVIDIA, NVDY. And the third one is Coney, CONY. And then the fourth one is MSTY, MSTY. All of those are under Yield Max. So look up Yield Max ETFs. They explain it all. They explain how they take their trades. They explain all the option trades they take. They explain all the yields. They give you a distribution schedule. It's a great resource on how to do it. But start with those four. There are people out there in internet land that have started with those four and have gone from $100 a month to 20,000 a month. It just go, and not in a long, because they haven't been around that long. All of these are 2024 and beyond. So, people have gone from zero to life-changing money in a hurry. Again, they're never selling. They're probably using margin, and they don't care about stock charts. But I would definitely check out Yield Max. Now, there are other calm ones, KURV, Curve. Those are the latest rage. They keep their stock charts pretty well. They're not quite as aggressive with their income, and they pay you less. So you can also look up KURV. Those funds are very, very popular, and they have like, I think 6 or 8. They just came out with some new ones. So that would be a way to dip your toe in, get paid. A lot of them will get paid weekly. And then one more to add, going back to Yield Max, YMAX, YMAX. That doesn't trade just one stock. That trades a whole basket of stocks, and they pay out weekly. So you could try that out. You could say, okay, I'm going to buy a couple shares of YMAX, YWM or YMAX, and see what it feels like to get paid every week. I mean, it's pretty fun to get paid every week. So you could try that out.
I lost £240,000, but I had made 200,000. So what I did is I put, I think it was £40,000 into a trading account at the beginning, traded it up to 240,000, then lost pretty much the lot. And that was, so people say, oh, yeah, but you turned 40 into 200, but the cracks were there. That was luck. That's because I didn't know anything about at that stage. No one had taught me about risk management. So I was sort of risking half of the entire account size on any given trade. So you've only got to have a few trades, and very quickly it's going to accelerate up. So I could have very easily quit at that point. The pain of losing £250,000 when you're very fragile, you don't realize it at the time. You were pretty much within my first year of trading. Yes, it's not my fault. I'm not full-time trading. I had a good career, but it still affects you. And it still affected me at that point to have seen all of that money that you've got in your trading account and then see it all wiped out. Literally down to the last $1,000 is what I had in that account when I blew it up at the beginning. I could have very easily walked away and then just said, well, I'm done with this and never come back to it. And I think I did take maybe a month off. Maybe I certainly took a bit of time, stepped away and just got engrossed in work. But there was something within me that said, look, must have done something right to have turned 40,000 into 240,000. And I was really enjoying it, and it'd be a shame to just give it back and to not continue with it. And so I guess that determination kicked in for me to think, no, I want to see if I can do this properly and see if I can do it again over a longer, more sustained period. And so I got back in the saddle. But I could have very easily given up. It was painful. Of course, when you take a big loss, it's hard. But something within me said, no, you've got to keep going. Risk management was the number one, realizing you can't risk, you can't bet your whole account or half of your account on a single trade. So I realized that, okay, right, there's something in this risk management thing. I thought it didn't apply to me. And I think a lot of people feel that way as well. They think that certain rules don't apply to them. And certainly I thought, I'd heard about trading psychology, but I thought, well, that doesn't apply to me. I'm a successful in my career. I don't need all of that mindset stuff. And then you realize you do. And I realized that the greed side of my personality needed to be reined in, and that if I carried on down that greed side approach again, then all I'm going to do is the same thing again, and I'll blow up again. So those were the things that I was looking at that stage, is how much I was risking per trade, massively bringing that down. And also accepting that if I allow my natural overconfidence to creep in, every time I was getting overconfident, what happens is you take trades that you shouldn't otherwise be taking. You put a bigger position size on that you would otherwise do, and then you give back any of your prior gains. And that was one of the things that I realized fairly early on, that if I could maintain more mindset discipline, that my equity curve stood at actually a better chance of sustaining an upwards trajectory. Well, I don't trade individual stocks anymore. So yeah, of course, your trading style is going to evolve. Mine has, in many regards, has changed. One, from the instruments that I trade. So I started out trading individual stocks. Then I went on to trading ETFs like the S&P, the SPY, QQQ, NASDAQ, and then on to trading futures and FX. So the instruments have changed. But interestingly, yeah, some elements of style have changed. Like during the great financial crisis back in 2008, 9, 10, I was predominantly day trading through there. I didn't do any swing trading for 2 years or so because the ranges got so big, the volatility was so wide, that the price ranges were so big that I wasn't bothered about swing trading. You know, an intraday move was the size of a swing trade today. It seemed at that time. So of course my trading evolves and changes, and still changes to this day with what's going on even right now with the new Trump administration. So yeah, you do change slightly, but as far as some of the fundamental aspects of what I use when I'm looking at a chart, yes, there are patterns that I've introduced because you see stuff, as the years go by, you see patterns that you identify. You think, I've seen this sort of price action before, and then you realize you can put it into a strategy. But at its actual heart, I still use price, trends, moving averages, which I remember putting so a couple of moving averages on when I first started trading, like a 10 and a 20 and a 50 and a 200. That was it. Those were the moving averages put onto a chart. And in essence, a couple of those of the periods have changed of some of the moving averages, but in essence, I still use moving averages, and I don't use them for crossovers and things like that, but I use them for visual confirmations of what's going on, and use them as support, resistance, as dynamic trend lines, and all these things. And that's not changed from the late 90s. So there are certain things that I still use today that I was using back then as well. I always say that a trader needs to maintain a very narrow emotional range. You hear people say over the years, oh, you need to trade without emotion. I believe that's impossible because we're human beings, and we are, as I always say, we're emotional creatures. You can't trade without emotion. Even if you're trying to trade with an EA or automated, you're still going to have emotions because you're still going to be looking at the trades, even if it's executed that way. And then you're going to tamper and interfere with the very system that you've got. But what we can do is try and desensitize our emotional range. And so I think one of the best things that a trader can do is to work on their mindset in order to do that. Because if you're getting overconfident, as I've talked about previously, when things are going well and you're having a bit of a winning spell, then you're just setting yourself up, if you get overconfident, for then making mistakes, like, doubling down on trades and over trading at that point because you have become overconfident. And likewise, if you become overly fearful when you've had a losing spell, then that's going to cause you to do what? Hesitate on trades, bank profits too soon, move your stops up too soon, all those sorts of things as well. So we can't trade with no emotion because that's impossible because we are human. But what we can do is try and desensitize the emotional range. And the better that people are at desensitizing their emotional range, so they're taking out the troughs and the peaks in their emotions, then the better you are going to be as a trader. So that was what I would say. The best thing you can do is that, because then you're not going to hesitate. You're not going to bank profits too soon, because those are all emotional things. They're drivers that are coming from your fundamental emotional backdrop. That's where all that's coming from. Get rid of all of that. Get rid of that emotional range. Now, how do you do that? One of the ways, the most simple way of reducing the emotional sensitivity to the markets is just to trade with smaller amount of risk. That's one thing that anyone who is struggling with emotions right now, desensitize. One thing I see of a lot of retail traders, they just risk too much. So if you're risking too much, your emotions are going to be higher. So reduce the risk and you can reduce the emotions. That's one of the quickest ways to do it. Now, sometimes you get a trader who's quite emotional and they're already risking quite a small amount. Then that might be because they're quite new anyway, and so they're still in their early development curve. And so that's okay. Still reduce your risk. The markets aren't going anywhere. As you get a thicker skin, a hardened skin towards the markets, then you might be able to creep that risk back up to where you would like it to be. But you have to recognize who you are as a trader. Are you fundamentally greed-based or fear-based? And then try and work on that and reduce the range. And I think if people can do that and trade more objectively, then they're going to be a better trader. Again, that's a restrictive, very, very restrictive, because people are treating trading like it's a job, like it's a career, like it's, you're going to get a pay packet at the end of the month. And if you approach it that way, well, what happens then if in your first week you've had a losing week? You're then thinking, well, I need to make 5% a month, and I now need to make up for the fact that I've not made any money this week to get to my 5% or my whatever amount. It's ridiculous. You cannot compare trading the markets to a job. And for a lot of people, actually, they might, if they looked at their overall P&L, it's the old 80-20 rule. You get 80% of your gains from 20% of the activity, and that can come through the course of a year as well. I'm not saying you can't make money every month, but if you put that pressure on yourself as saying, I need to make this amount per month, per week, per day, then that's not good, because you're not going to be trading objectively. So you need to park that and appreciate that 1 month you might be flat, and then the next month you might have a bumper month and do really well. So I think having targets is a dangerous thing, because it creates emotions by itself. Have a loose target of how much you would like to be achieving over the course of a year, but appreciate that in the financial markets might go quiet for periods. They might go super volatile. All these things that are outside of your control, all you can do is control the controllables and deal with your processes, and accept that there's going to be months that you're just out of sync with what the markets are doing. If you put a target on of what you're going to do, well, that's dangerous. And just see trading as a long-term endeavor. It's not about how successful you are today, this week, next month. You're in it for the long term. So try and desensitize the amount of focus you're putting on how much money you want to make today or this month. I'm, with all my experience over the years, adapting myself at the moment to this new world that we're in, because even from when we're doing this interview today, yesterday evening, the evening before that, it's relentless. I'm here in the UK, and so some of these announcements are coming out overnight. And so what are you going to wake up to in the morning? How the market's moving, because there might be tweets or whatever that have gone out, or so one thing I think that is a simple trick that a trader can do is just to look at your stop losses and maybe have wider stops, because to take into consideration the increased noise that's there. So an example yesterday would be, it doesn't matter about the dates, but at the time of filming, the stock markets were down, then they rallied, put in a big bounce and went green, then turned back to red again by late in the last half an hour. And so I think that if you're in a position, then generally speaking, widen your stops beyond what they normally would be, just to try and account for the noise. Reduce the position size and have a slightly wider stop, just to try and cater for that sort of noise that we're getting during the course of any given. Again, depends on whether you're a day trader or a swing trader, but the same principles apply. If you're an intraday trader, maybe have slightly wider stops than you would normally do, just to deal with that noise. But it's the same for swing trading as well. I think that in some regards, it's good to be in and out. And I don't mean off an intraday trade, but even from a swing trading perspective, in some regards, because even on end of day charts, markets having a bit of a run, and then they'll go and do quite a big reversal. So in some regards, banking may be a bit sooner than you would otherwise have done, or taken a portion of your trade off. Maybe for some people might be a better thing, given the volatility and the way the markets are moving around. So that would be the main thing. And it's the same for intraday as well, especially for intraday. You need to be a bit more on it, because of the risk of intraday reversals is very high at the moment, based on, look, up until 2 months ago, we just had to deal with economic news releases. Now we've got economic news releases, plus we've got Donald Trump, we've got his team, who could all be tweeting or giving news press conferences at any time, which can dramatically change the course of the market. So I think for intraday traders, they've got to be much more on their game with regards to anything can come out and the markets can turn. But I'm more of a swing trader these days, but it still is going to affect a swing trader, because you can be in a nice position and then in the space of half an hour, the market's all turned and your nice looking swing trade doesn't look quite the same. It's just the relentless nature of what's going on. We've got geopolitical events, obviously, with what, the Ukraine-Russia war. We've got the Middle East uncertainty still. You've got a US that are looking to reduce their amount of debt. So they're making some quite dramatic moves with regards to their own economy, tariffs, all these things are all being thrown into the mix, which you're right, that you can be in what looks like a nice position and then it all changes. But one thing that I would say though is it's certainly keeping things interesting. So, it's a lot less dull than it was, last year. That's for sure. Whether that's a good thing or not, I don't know. But it's certainly keeping things very interesting. And certainly, on a personal level, I'm having to spend more time keeping an eye on the markets than I was last year, because the markets, you get into the thick end of the US session. So like the US afternoon, where normally in FX, you get past the London FX close and they're all pretty much dead after that. Not now. They're still moving a lot of the time, and obviously the stock market. So we're certainly seeing some differences there. So I'm having to keep an eye on the markets a lot more. It's not that it's necessarily going to change what I'm doing, but I'm having to monitor all my positions more than I would otherwise be doing. But it's different.
All right, so there you have it. Hope you got some value out of this. Hope you got some good advice from these traders. Comment below with your favorite advice, favorite quote, or one-liner you heard in this video. I want to hear what you think. Make sure you're subscribed if you haven't done yet. And I'll catch you back here in the next video pretty soon. Ciao.